The Coca-Cola Company, ticker symbol KO, is up about 5% today to $67.47 a share. Reason for this, they have released their fourth quarter and full year earnings for 2024. What we're going to be doing is looking at these earnings, talking about them, then going to my automated stock valuation spreadsheet, seeing if Coca-Cola is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. Before we do that, let's have a look at some of these and see why the market has reacted pretty positively to Coca-Cola's earnings. Just some notes from the CEO. Our all-weather strategy is working and we continue to demonstrate our ability and lead through dynamic external environments. Our global scale, coupled with local market expertise and the unwavering dedication of people and our system, puts us in a unique position to capture vast opportunities ahead. Nice words, but let's see what the numbers are saying. Revenues for the quarter, net revenues increased 6% to $11.5 billion. Operating margin, 23.5%, up from 21% on the prior year. We also have earnings per share grew 12% to 51 cents. While comparable earnings per share non-GAAP grew 12% to 55. Market share for both the quarter and the full year, the company gained value share in total non-alcoholic ready-to-drink NARDT beverages, and cash flow for the full year, cash from operations and free cash flow were 6.8 and 4.7 respectively. So things are looking up. So what we'll do is we'll just quickly go through these numbers. I'll just scroll down the bottom and we can see here. Let's just keep scrolling. Right, so what we do is we have the 3 months ended 24 and 3 months ended 23. And before that, actually, we'll just put in the ticker KO, and this will load up all the company financial data. We don't have the most recent earnings, but we can manually override them, which is what we're doing now. So KO, Coca-Cola Company, $67 a share and 45 cents, up about 5% in the day. $290 billion market cap, a PE ratio of 28.3, meaning actually it is lower than the market average currently. Earnings per share, $2.41 and a beta of 0.61, meaning it is a lot less volatile than the market. Analysts saying it is a buy with a target price of $71.71. Dividend, it's a favorite among dividend investors, 3.04% yield, meaning you will get $2.05 a share. They pay around $8.8 billion in total dividend. In terms of the net income, 84%, and actually more than the current free cash flow, but we'll update the numbers and see if that's the case. Historically, obviously, very safe dividend, but yes, a little bit high at the moment. And if you want to get paid by before the end of February, and you will get paid your quarterly dividend. So let's go to the revenues here. But first, we will look at the numbers and we'll input them into our sheet. Revenues increased $10.8 billion to $11.544 billion. So what we'll do is we'll input it in here, 11.544, and you can see that's changed the total revenue number now to 47.1 billion. We'll just quickly put in the net income as well. Up slightly, as you can see, 1.973 billion to 2.195. And we'll just quickly go into the free cash flow as well. We did see the number before, but we can get it from here. So net cash provided by operating activities, easy for me to say, it is down a lot. You can see here the differences though. But 6805, so I'll just do that. 6805, and the capital expenditures here, purchase of property and equipment, 2064, and then we'll just do, oh, thank you. So there you go. So that's 4.7 billion up to 6.3. So we'll look at the revenues first. This is the revenues going back to 2009, but since a certain thing happened in 2020 where it was added to the lowest it's been in many years, Coca-Cola has actually grown and has got about a 6% compound annual growth rate, so looking promising. Not all-time highs, but definitely increasing, which is what we want to see. If I do go back to here, we can see the segments. This is net operating revenues. Europe, Middle East and Africa, Latin America, North America, Asia Pacific, Global Ventures, Bottling Ventures, Corporate. And as you can see here, everything is looking up. The largest market is obviously North America. That is up 16%, the highest here. Asia Pacific next with, Latin America, 10% growth. Europe, Middle East and Africa, which is their second largest segment, 6%. Then Asia Pacific, up at 9%, 1.1 to 1.2, and then global ventures slightly less. Bottle investments down, corporate down, eliminations down. But you can see here that their largest segment is growing, which is what we want to see, and their second largest segment is still growing. All the segments are growing, which is what we want to see. Next, we'll have a look at net income. 10.63 billion. So as we can see here, not all-time highs or not recent highs. 2023 was higher. If we just quickly go back to here, this is the operating income. Up. Everything is up quite a lot. Once again, North America was profitable. Then next, Latin America. Then EMEA, or Europe, Middle East and Africa. 2%, very small growth. And then Asia Pacific last. But increasing, which is what we want to see. Free cash flow. Yes, 6.633, easy for me to say once again, 6.33 billion, down from the previous ones. Now, if we look at operating cash flow versus capex, you can see operating cash flow is down, which is why operating cash flow is down, capex is up, but free cash flow is down as well. Shares outstanding, are they buying back their shares? Historically, they have been, but you can see it's been relatively flat, but they have bought back shares, rewarding shareholders. So let's have a look at the discounted free cash flow model. This is where value in stocks, looking at their future free cash flows, discounting their day's value, and then it'll see if it's a buy or a sell. So currently it's giving us a price of about $67 exactly. Let's see if we agree. First, we look at the revenue estimates. We're expecting about 6%, 7% growth, 50 and 53 billion. Let's see if analysts agree. Much slower than that. 50 billion. Yeah, not as good. 7% growth. So in fact, I would say this is a little bit on the bullish side. We'll bring this down to about 4%. Say $60. Net income margins, I'm pretty happy with them. Free cash flow, I mean, I think we'll keep this as it is. So not looking to buy, but if we look at the weighted average cost of capital, Coke's is lower. So if we were to copy this exactly, you can see it is actually a buy at $78 a share. Normally we have sorry, let me just make this full screen again. Normally it is high, about 8% discount, but the weighted average cost of capital of Coke is lower. Dividend discount model, let's see what this says. They currently have a growth of about 4.3%. Weighted average cost of capital is 1.61. Says it's undervalued by quite a bit. Now, this growth, I wouldn't say that this is probably a little bit on the high side. Yeah, I think we probably want to bring this a little bit lower. But then to be fairly valued, if they keep on growing it at over 3.5%. Oh, wait, sorry, I haven't copied that discount rate exactly. My mistake. 3.7. Yeah. So as long as they're growing their dividend over 3.7%, then it is a buy. Ben Graham formula for intrinsic value. I don't think you'll like this stock. We'll quickly go through it. I think we saw that KO has about 7% growth. No, high bond, inflationary environment. Ben Graham hates all the stocks. But finally, let's have a look at the comparable company model. This is a way of valuing stocks, looking at their competitors of similar industries, and we'll be comparing revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, PEG, and then the specific metrics here are EV to revenue, EV to EBITDA, PE, and forward PE. So I think the biggest direct competitor is, of course, Pepsi. Ticker symbol PEP, and this will load all the latest company financial data for these companies. And if you're interested, please check out my Patreon, links are in the description. It's the $4 tier if you want the sheet. We've got 11 members at the minute who are paying for this and using it, and they're pretty happy. Also, if you want to buy the more expensive one, which also includes me doing reviews for you, then $7 a month, or if you just want to help me out, $1.50. Anything will be appreciated, but I prefer it if you bought and used the sheet, because then I'm providing you guys a service, which I do enjoy. And hopefully you guys can use it. Anyway, next one, Keurig Dr. Pepper, KDP. And finally, we'll do Monster, MNST. So enterprise value, KO is the biggest. Second highest revenue, Pepsi blows them all out of the water. Revenue growth rate, they're the lowest. EBITDA, second highest. Coke is the most profitable and highest margins by quite a bit compared to Pepsi, and definitely only Monster comes close. Price to sales, market average is about 3.1. KO is higher than this. Price to book, market average is 5, lower. PEG, price to earnings growth, which is Peter Lynch's, Ideally, you want this under 1, and they're all above 1. EV to revenue, Coke is the highest. EV to EBITDA, second highest. PE, second highest. And forward P, second highest. Puts it at about $51 a share. So compared to its competitors, not a buy, which is quite interesting. What I also want to do here is just look at Pepsi directly. Let me just make sure this is doing it right. Yep. Compared to Pepsi, EV to revenue higher, EV to EBITDA higher, PE higher, $40 a share. So quite interesting. Yeah, so not a buy on the comparable company model, not a buy on the Ben Graham formula. Dividend discount model says it's about fairly valued, and the discounted free cash flow model, not that one, sorry, says it is a buy. So quite interesting here. But since the last time we did this video, it was around about November the 18th-ish, and I said it's probably a buy on the models because KO is normally trading a lot higher, and it's up about 10% since that point. So anyone who bought it because of that, good luck. But you can see normally it has these quite big swings where it sort of drops down at about 10%, and then jumps back up. So it's dropped down about 10% here, and hopefully it's on its way back up. You can see it's got 10% increase since I last did a video on it, but hopefully it can keep rising. It has underperformed the market over the recent years. You can see over the last 5 years, about 12%. If we go from the bottom of the pandemic, which I think is more of a fair estimate, market is about 100% since then. KO is about 75%. Over the last year, 12%. Market is probably about 28%, maybe 20%. 28% would be crazy. Yeah, but one of the reasons people like this is its nice dividend yield. So, as I said before, buy before the end of February if you want to get paid your quality dividend. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. And I'll catch you guys next time. And check out the Patreon.